Most people think they understand how money works. They see interest rates rise and fall, watch stock markets climb and crash, and assume these movements reflect some natural law of economics. But if you look beneath the surface, you'll discover something far more deliberate. A handful of institutions operating in marble halls and glass towers quietly orchestrate the flow of trillions. They don't announce their power. They don't seek headlines. They simply pull the levers that move the world. Central banks are the hidden architects of modern finance. Every mortgage payment you make, every credit card bill you receive, every government bond that funds your nation's debt traces back to decisions made in boardrooms most people will never see. These institutions don't just manage money, they create it, control it, and direct its flow with a precision that would make ancient emperors jealous. And the most remarkable part is how invisible their influence remains to the very people whose lives they reshape daily. To understand how central banks rule global finance, you have to start with a simple truth that most economics textbooks skip over. Money is not what you think it is. It's not gold sitting in vaults or paper printed by governments. Modern money is debt, created by banks when they issue loans, and controlled by central banks when they set the terms under which that creation happens. When the Federal Reserve adjusts interest rates, when the European Central Bank launches quantitative easing, when the Bank of Japan intervenes in currency markets, they are not responding to economic forces, they are creating them. The Federal Reserve, established in 1913, was sold to the American public as a way to prevent financial panics and ensure stable money. But from its very beginning, the Fed was designed by and for the banking industry itself. The meetings that created it were held in secret on Jekyll Island, attended by representatives of the nation's largest financial institutions. That they didn't want government control of money. They wanted the appearance of government oversight with the reality of private influence. And that is exactly what they built. Today's Federal Reserve operates as a hybrid creature, neither fully public nor entirely private. Its board of governors is appointed by the president and confirmed by Congress, giving it the veneer of democratic accountability. But the real power lies with the regional Federal Reserve banks, which are owned by the commercial banks they supposedly regulate. When JP Morgan Chase or Bank of America needs liquidity, they don't petition a government agency at. They call their colleagues the New York Federal Reserve. The system regulates itself, profits from itself, and protects itself with a sophistication that would make medieval guilds seem transparent. The European Central Bank operates under different structures but achieves similar results. Created in 1998 to manage the euro, the ECB was designed to be independent from political pressure. Independence sounds admirable until you realize what it actually means. Politicians elected by voters cannot directly influence monetary policy, but bankers, bond traders, and financial institutions have constant access through advisory committees, research partnerships, and the revolving door of personnel that moves seamlessly between central banks and commercial finance. Independence from democracy is not independence from influence. It is influence by different masters. Central banks maintain their power through the control of interest rates, but this simple phrase conceals a complex web of global manipulation. When the Federal Reserve sets its federal funds rate, it is not just determining what American banks pay to borrow from each other overnight. It is setting the baseline for borrowing costs across the entire planet. Emerging market countries that issue debt in dollars suddenly find their financing more or less expensive based on decisions made in Washington. Pension funds in Europe adjust their portfolios based on Fed announcements. Housing markets from Toronto to Tokyo respond to signals from the Eccles building. This is not accidental. It is the architecture of financial dominance, built carefully over decades. The dollar's role as the world's reserve currency gives the Federal Reserve power that extends far beyond American borders. When the Fed creates money through quantitative easing, that liquidity doesn't stay in the United States. It flows into global markets, inflating asset prices, distorting exchange rates, and forcing other central banks to respond. They must either match American policy or watch their currencies weaken, their inflation rise, and their economies destabilize. The Federal Reserve doesn't just run American monetary policy, it exports it to the world. But central banks don't work alone. They operate within a network of institutions that most people have never heard of, but that shape global finance more than any elected government. The Bank for International Settlements in Basel, Switzerland, serves as the central bank for central banks. Every month, the heads of major central banks meet there to coordinate policy, share information, and align strategies. These meetings receive no media coverage, publish no transcripts, and operate under rules of confidentiality that would make intelligence agencies proud. The BIS doesn't just facilitate cooperation, it sets the standards that govern global banking. The Basel Accords, a series of international banking regulations, determine how much capital banks must hold, how they calculate risk, and how they report their activities. These rules, negotiated behind closed doors by central bankers and implemented without democratic oversight, have more influence over global finance than most national legislation. When a local bank in Brazil or Bangladesh makes a loan, it must follow rules written in Switzerland by people who have never been elected by anyone. Central banks also control the infrastructure through which money moves around the world. Payment systems, clearing networks, and settlement mechanisms all operate under central bank supervision. This gives them the power not just to create money, but to decide where it can go. When the Federal Reserve wants to pressure a country, it doesn't need military force. It can simply restrict access to dollar payment systems. Suddenly, that nation's banks cannot process international transactions, its companies cannot receive payments, and its economy begins to suffocate. Financial sanctions have become the modern equivalent of siege warfare, and central banks control the gates. The complexity of these systems is not accidental. It is camouflage. When monetary policy is explained in technical jargon, when decisions are justified by econometric models, when power is exercised through interest rate adjustments measured in basis points, the public paying stops attention. Democracy requires transparency, but central banking thrives on opacity. The more complex the system becomes, the harder it is for ordinary citizens to understand how they are being governed. And what people cannot understand, they cannot resist. This obscurity serves another purpose. It allows central banks to socialize losses while privatizing gains on a scale that would trigger revolutions if conducted openly. During the 2008 financial crisis, the Federal Reserve created trillions of dollars to rescue the very banks that had caused the collapse. But this rescue wasn't presented as a bailout. It was packaged as quantitative easing, asset purchases, and liquidity provision. The language made it sound technical rather than political, inevitable rather than chosen. The mechanics were elegant in their simplicity. Central banks bought government bonds and mortgage securities from commercial banks, flooding the system with fresh money. This money didn't trickle down to ordinary households struggling with foreclosure. It stayed within the financial system, inflating asset prices and ensuring that bank balance sheets recovered quickly. Stock markets soared, real estate rebounded, and executive bonuses returned to pre-crisis levels. Meanwhile, millions of families lost their homes, their jobs, and their savings. The central banks had successfully transferred the cost of financial recklessness from the institutions that caused it to the public that suffered from it. But the true genius of central bank power lies not in crisis response, but in everyday operations. Through something called the yield curve, central banks shape the entire structure of interest rates across the economy. By controlling short-term rates directly and influencing long-term rates through bond purchases and forward guidance, they determine the cost of borrowing for everything from credit cards to corporate expansion. This power extends beyond simple price setting. It shapes behavior, incentivizes certain activities while discouraging others, and effectively steers economic development according to central bank preferences, central. When banks keep interest rates low, they punish savers and reward borrowers. On fixed incomes, watch retirees living their savings earn nothing while corporations borrow cheaply to buy back their own stock. When rates rise, the equation reverses, but the pattern remains the same. Central banks are not neutral arbiters responding to market forces. They are active participants creating market conditions that benefit some groups at the expense of others. The question is never whether central banks should intervene. The question is who benefits from their intervention. The coordination between major central banks has become so sophisticated that they operate almost as a single global institution with regional branches. When the Federal Reserve announces policy changes, the European Central Bank, Bank of Japan and Bank of England adjust their strategies accordingly. Currency swap lines allow them to provide each other with unlimited funding during crises. Their research departments share data. Their officials rotate between institutions, and their policies align with a precision that suggests central planning rather than independent decision-making. Central banks have constructed the most sophisticated system of financial control in human history, one that operates in plain sight, yet remains invisible to most of those it governs. They have turned money itself into a tool of power, debt into a mechanism of dependency, and complexity into a shield against accountability. The question is not whether you understand their influence. The question is whether you will recognize it before it reshapes your future completely